Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's Friday the 17th of May. I'm Jeffrey Halley, your host today, and we are joined by Kelvin Wong, a great friend of the show, and also Senior Market Analyst at Oanda in Singapore. Kelvin, welcome to the show.
Hey, welcome. Very good afternoon, Jeff, and happy Friday to you as well, and good to see you again.
Lovely, cheers for that. Kelvin, let's just jump straight into it. We saw Singapore's non-oil exports or NODX data coming out this morning. On a year-on-year basis, that number slumped by 9.3%, but it rose by 7.6% on a monthly basis. Now, this is a very volatile data set, but what is it telling you about the state of the Singapore economy at the moment?
Yes, for sure. So if you look at the headline numbers, it seems to be a bit discouraging because of the slump on the year-on-year basis for NODX. But if you dive into the NODX component and break down into the two main components of electronic products and the non-electronic products, so basically what we could see is the decline year-on-year for the month of April has been kind of hampered by the non-electronics product, which actually declined by negative 12.3%, contributed by pharmaceutical, which is quite volatile in the component. But one thing more encouraging is stating more skewed towards, i.e. towards the global electronics or semiconductors state of the affairs, is that the electronic component of the NODX actually recovered in the month of April. So it actually increased to 3.3% year-on-year, after a 9.5% year-on-year that was recorded in the previous month of March. And if you look at the current, if you kind of break down a 3-month moving average of this electronics component of the NODX product, it's actually showing signs of a substantial recovery that has been taken shape in the late last year, which is December. So what it implies over here in the semiconductor or the global electronics industry is that global electronics growth seems to be still on the firm footing of picking up. That means, i.e., it could actually support the various firms or industry that is heavily skewed towards this semiconductor space.
And I actually was out last night. I'm in Singapore this week, and I was out for dinner with friends last night, and town was actually very, very busy. So perhaps the worst is actually over for Singapore for now. Let's turn to US markets now.
Yes.
One thing that stood out to me overnight was that this post-US-CPI rally, it seems to have run out of steam as quickly as it began. Stocks are sideways, the US dollar rallied, commodities have eased. Why has this Fed easing momentum stopped as quickly as it began effectively?
Well, I would say that firstly, we got to take a step back. At this point in time, if you look at the current medium-term trend that has taken shape about 2.5 weeks ago, the odds are still skewed towards the bull side of the story because it's still trading in a very firm uptrend on the major US stock indices, especially taking a look at the Dow Jones, the S&P 500, the Nasdaq 100. They're still firmly above their 50-day moving average, but not so for the small cap Russell 2000 because they are more kind of being hampered by this environment of a higher interest rate for a longer period of time, and also due to the fact that they are much more skewed, or the component stocks within the Russell 2000 do have a heavily debt burden ratio, so that doesn't gel well for them in terms of their profit margin. And also on the other hand, to explain yesterday's we call it lackluster or negative movement on the major US stock indices is due to the fact of a very short-term overbought condition that has been made on the prior short rally. That means on the rally that has taken shape right after that we call it that I'll put it that rosy tinted glasses market view towards the core CPI data that, in my point of view, it doesn't really showing clear signs of deceleration yet. Why? Because if you break down that particular component using this super core CPI component is actually one of the key metrics that several Federal Reserve officials They did mention in their public speeches they are actually using this particular component to monitor the state of the inflationary trend in the US. And I would tend to be much more stringent. I look at that sticky price, sticky super core. That means it's sticky CPI, less food, less energy, and less shelter. So if you look at this particular sub-component, for the April figure, it's actually pretty much consistent with the previous month of March figure. So in April, they came in, this particular sub-component, I call it the sticky super core CPI. It came in at 3.13% year on year for April. And that's almost similar to March figure of 3.5% year on year. And slowly there has been inching upward from 2.7% year on year that was recorded in November last year. So what we could see over here is that in the last, we call it 4 or 5 months or so of year on year change of this sticky super core CPI metrics, it seems to us that the state of the inflationary trend in US is not really showing clear signs of deceleration versus what we see in other developed nations like UK, Eurozone. So that actually also saw 3 Federal Reserve officials came out yesterday to actually give the guardians to the market, saying that, hey, it's time to hold your guns, do not be over exuberant yet, to say that the Fed has already met their goal of achieving that 2% target in the near term.
Okay, so getting from 3% to their 2% target is going to be a lot harder than getting from 8% to 3%.
Yes.
One of the main beneficiaries I can see in markets overnight was dollar yen. So it fell sharply to 153 handle after the US CPI numbers. It's pretty much unwound all of those losses. Dollar yen's just shy of 156 this morning. What's your outlook? What's your outlook for the technical picture for dollar yen at the moment?
Okay, so for sure for the dollar yen in a very short term on an intraday basis, it seems to us that momentum is coming back, because if you look at the current Asia session right now, it's actually taken off the 20-day moving average at this 155 5540 level. So that level was kind of being hesitant yesterday during the US session, where it tested and there was a bit of pullback for the boost. So what we could see over here is that yes, there could be some form of short-term momentum coming back into the picture by short-term speculators. The key resistance that I'm watching at will be at the 157 level. And do not forget over here is that from a fundamental perspective, what's interesting over here is that we can argue the fact that yes, we know that the Japanese data for Q1, the Q1 GDP numbers came in fairly bad at the state of, we call it a negative growth. So a lot of people in the marketplace saying that, hey, perhaps we may need a weaker yen to actually support the Japanese economy. But do not forget over here is that the Q1 GDP data in Japan is actually, we're talking about, is lagging, and it's that the data actually was actually also compiled before the conclusion of that massive we call it a nationwide wage increase that hasn't been actually filtered through the economy yet, because that only conclude towards the end of March, I would say. Then do not forget over here is that what I see over here is that instead the longer term JGB yield, which is the 30 year, so that actually the BOJ didn't actually control about the 30 year, but they're more control the 10 year by doing potentially buying of bonds on the 10 year side of the story. The 30 year is much more freehand dictated by the market. So it seems to us that the 30 year JGB yield didn't actually slide that much. So in fact, it's still hovering at close to, I think, a level that was last seen in, I think, 2011. And what's interesting over here is that with this strong major uptrend since last year, that could actually prompt Japanese insurance company, we call them the lifers, to actually potentially do a bit of capital portfolio allocation to reduce their US Treasury holdings and being we call it kind of putting more weightage towards longer term JGBs because of this higher attractive JGB yield. So going forward, if this flow starts to materialize in the next couple of months, that could also potentially put a lid on the dollar strength against the Japanese yen. So something
Right.
to actually to be mindful of it.
Okay, so more volatility ahead for sure for the Japanese yen. Kelvin, thanks so much for joining us today. Always wonderful to have your insights.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda in Singapore on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley, and this video and podcast will be available on our website, www.biztech.asia, as well as our social media channels. You can also catch this show on our syndication partners' TV, radio, and websites. Please like and subscribe. Thanks for tuning in today.